If you've got a pension, unfortunately, I've got bad news for you. Pensions right now in the United States and in most places around the world are screwed. Number one, because you cannot control how they are invested. Number two, you can't control how they're funded. And number three, the people who are in control of how they are invested are basing their investment decisions off of very old, flawed investing models. Ready? Let's dive in. All right, guys, the first thing we need to look at here is the 60-40 portfolio. Many experts have been claiming for a while now that the 60 portfolio is basically dead. This is not a strategy that you want to be in a macro environment that we're in right now, where rates are at an all-time low and stock market valuations are at basically an all-time high. They had their worst loss since March of 2020. What is the reason for this? Well, basically the reason for this is because of the Federal Reserve's anticipated rate hikes. There's a big question about how far the Federal Reserve will go with their tightening policy, whether they'll raise rates 3, 4, 5 times this year, how much they'll raise rates by when they do raise the rates, what will happen to their balance sheet as they pull out of buying bonds and potentially start to sell bonds actively into the market, and then what will inflation do as a result as well, because inflation is going to be taking a toll on the nominal returns that any portfolio gets and will make the real return lower. Economic growth is slowing down and corporate earnings are slowing down as interest rates are getting hiked. Because of this, the 60-40 portfolio lost 5.4% in January, which is again the worst since March of 2020. So just in case you're not aware, I didn't say this at the beginning, 60-40 portfolio, 60% in stocks, 40% in bonds. And when interest rates look like this from 1980 through now, basically all they've done is gone down. You have recency bias. When you have 20-year, 30-year, 40-year studies that go back and they look at the awesome performance of a 60-40 portfolio, obviously that's going to look good because you're basing it off of the peak in interest rates. Interest rates were at a high in 1980. So all of the data that you're looking at from this time period, obviously bonds are going to look great and they're going to perform great in your portfolio because the price of bonds goes up as interest rates go down. At the same time, when you look at what the S&P 500 has done since then, obviously that portfolio is going to look very attractive. But what happens when rates hit zero? That's a ceiling for bonds. Rates can't go below zero unless the money is forced in to those investments, which for many pensions might actually be the next step. That's the case all around the world where pensions are required by law to invest in negatively yielding debt, sovereign debt. But at least in the United States, at this point, we are not there yet. In either case, you can't go that far negative. So there is somewhat of a ceiling there at the zero interest rate level there for bonds to stop appreciating in price, which means that the 60-40 portfolio, half of your portfolio, 40% of it, is invested in something that has no ability to appreciate in price. Further than that, you say, okay, well, I'm not investing in bonds for appreciation. I'm investing in stocks for appreciation. I'm investing in the bonds for income. What income? If it's 0%, even if it's 1%, 2%, the 10-year is a little bit below 2% right now. The 20-year is a little bit over 2% right now. If you're investing for income, what income are you investing in right there? There is none. And so you're capped on your appreciation and you're capped on your income at basically zero. Now throw inflation in the mix. What's your income? It's negative. Now, your best case scenario is that you lose a little bit, 5, 6, 7% to inflation, or you lose a lot on a default. Now switch over to stocks. Stocks have done nothing but go up. By many metrics, stocks, even with this, historically, this little drop that we just experienced over the last month, one of the worst months in recent stock market history, did nothing. valuations are still at all-time highs, some of the most expensive stocks ever, and we'll get back to that in a moment. And so 60/40, this is the portfolio that professional investors, professional money managers put pensions in. That is the consensus on the safe way to invest. You got a little bit in stocks, a little bit of bonds, have some appreciation, have some income, but like we just covered, that's not reality. It's not actually there, which has gotten 60/40 portfolio managers looking at owning more dividend paying stocks, allocating more to alternatives while underweighting bonds, because the 60/40 portfolio doesn't work. So you can't just do 60/40 anymore. You've got to do other stuff to mix it up to make up the difference. What's the problem with that? Take a look at this. NASDAQ, worst January in its 50-year existence. Not worst month, but worst January. Let's look at the NASDAQ here. This drop here that happened in January was about a 10% drop. And yeah, it was the worst January, worst start to the year that the NASDAQ has ever had. And if you want to get more aggressive with your 60/40 portfolio to make up the difference, this is what you're buying. You're buying the more aggressive investments, which are in the NASDAQ. And even if it's not, even if it's just regular stocks, S&P 500 did the exact same thing. Fell 9% in January. That counts for the little bit of a rebound that we had recently. I believe it was just about 10% from the top to the bottom for January. And it gained 3.4% just today on the day that I'm recording this. This S&P 500, let's go to NASDAQ. This little bump from Friday's close to today, up 3.5%. Moves like that rarely happen. In fact, it was its best two-day rally since 2020. Again, back here, when everything fell apart in March, you have massive rallies, usually during bear markets. So when you have big collapses in stock prices, normally you have giant, fast rebounds. Now, personally, I could be totally wrong about this. I think this was the short-term bottom. I think we're going much higher from here. I don't think we'll put in a new low very soon here beyond this. I think we're going much higher now. I think that was the short-term low. In any case, that's what you're investing in, those more aggressive stocks that are much more volatile when your bonds stop performing and you're introducing much more risk into the portfolio. Now we look at U.S. public pensions. So we're talking about pensions broadly because 401ks, IRAs, brokerage accounts, you have control. Even with a 401k, you might not have all control, but there's options. There's ways that you can, get in there and change the funds that they're invested in. Many times there are self-directed accounts within 401ks that you can invest in stocks or things like that. But pensions, you have no control. You have no control on how it's invested. You have no control on what's chosen to go into the portfolio. You have no control over how much money is going in, how much money you're going to be able to get out. You have absolutely no control over these things. And so the professionals who know better, they're the ones making the decisions about this, leading to the difference between assets and liabilities at U.S. public pension funds, which is known as the funded ratio, unsatisfactory, less than 75%. That means that there's not enough money coming into the pensions to pay out for everybody who needs to get paid out. We're at about 75%. And keep in mind, that's not accounting for the fact that 10-year treasuries are at a 40-year low in terms of interest rates. That is calculated, just so you know, based on normal interest rates at 4, 5, 6%. And so that number is not accurate. Public pensions are in much deeper trouble than that. And even with public pension funds rising a record $31 trillion, almost $32 trillion in 2021 because of asset price appreciation, still didn't move the needle. And finally, to make matters worse, the working population is expected to decrease from 64% to 57% by the end of the 21st century, and it could probably be much more severe than that, but essentially that's talking about an aging population. And so the way that pensions work, there's a lot less people putting into the pension than there are taking out of it. That will make things much worse. Now, keep in mind, what did I say earlier? That they're going to be having to invest in more aggressive strategies and more income, more dividend-paying stocks in order to make up the difference. Well, take a look at this chart from Multiple. chart.com, you can see here from 1880, long-term chart here, what the dividend yield on the S&P 500 is, S&P 500 dividend yield. So really, for 100 years, this was volatile, but it basically moved sideways. The dividend yield on the S&P 500 was pretty much range bound here between 3 and 8. Yeah, there was this spike here. We dipped a little bit below a couple times, but for the most part, it was range bound between 3 and 8. Towards the end of the 80s, beginning of the 90s, that all changed, and the dividend yield of the S&P 500 has collapsed, and it is the lowest it's ever been, besides just a little tiny blip here in the early 2000s there, 1.34%. So if you're needing to increase your income of your 60-40 portfolio, if you're needing to increase the income for your public pension funds or your regular pension funds, your private pension funds, you're not going to do it by adding S&P 500 dividend-paying stocks. They're not out there like they used to be. And so the only thing that you're going to be able to do to increase your return is go into more aggressive, more risky stocks. And at the end of the day, here's what's going to happen, because so many people, voters, keep in mind, are dependent on their pensions paying out what they've been promised. So here is exactly what will happen. Congress, the pain point, it'll be pushed and they will fund pensions. Maybe they'll nationalize them. Maybe they'll set up some sort of special agency. Maybe the Federal Reserve, they'll have the Fed get involved. I don't know the details of how this will work out, but they'll print the money to fund the pensions because there won't be enough money in there to pay the bills. It's not invested in bonds that will produce the return, stocks that will produce the return, and they're not getting the funding that they need to produce the return. They will print the money to make the payments. What is that going to do? That will mean that people will get the dollar amount they're promised, because then they'll be happy enough to vote the people back into power. But the amount of stuff that they'll be able to buy with the dollars they were promised will not be as much as they thought it would be. They'll get the number of dollars, but the value won't be there. Purchasing power will drop, inflation will go up, and nobody will know why. Because at the end of the day, the politicians, all they care about is getting voted in again. They're not going to let a massive base of voters vote them out for something they can just write, with a press of a button and a swipe of a pen. They can make this problem look like it's going away. They can fund these pensions, UBI for anybody with a pension, just write the check, fill up the pension funds with all the funding that it needs so that the number of dollars go out, regardless of how much those dollars will actually buy. So bottom line, don't rely on your pension. Your pension will not be able to sustain the real income that you're getting for the next 10, 15, 20 years. It won't be there. It will be eaten away by inflation because the returns on the investments, both the stocks and the bonds in the portfolios, are not there, and the funding is not there either. And when it does get funded by Congress through the printing of money, the value of the dollars that you'll be getting will be much lower than the value of dollars today. As always, really appreciate you guys. Thanks so much for watching. Have a great day.